It's not bad, not good, great. There are a lot of problems that the world economy and the U.S. economy and Europe and the U.K. and Japan all face, as do China, South Africa, and other countries. And one not ought to be sanguine and expect that everything is going to work out fine. One should be fully cognizant that recessions do happen and that we probably are overdue for one. And there were signs. Good morning. It's Jeffrey Christian, CPM Group. It's about 11:30 in New York on Friday, the 2nd of June. I wanted to talk today about the economy and gold and silver a little bit, sort of a high level. On Tuesday's video, we went into greater detail on the economy and on gold. And I think we'll probably do that again in the future. But I wanted to go back over some of these areas and talk at a higher level. And I titled this, let's be honest about the economy, gold and silver, because over the course of this week, I've watched an incredible array of people really saying things that are clearly not honest, and they probably know better. Maybe some of them don't. But, I think it's a matter of intelligence as well as integrity and ethics. And it wasn't just on gold and silver. It was really across every aspect of human life, from politics and the economy to finance and banking and social interactions and education. It's just really an appalling lack of either knowledge or ethics or some combination thereof. And I shouldn't be surprised. It's always been that way. I think it probably is a little bit worse now than it was in the recent past. But it definitely has infected precious metals markets as well as commodity markets. We've gone through the silver squeeze scam, and we've gone through the silver is running out, COMEX is running out of silver scam. We've gone through all sorts of stuff about all the gold and silvers moving out of Europe and the United States to Asia. We've shown you data that says, no, that's not actually the case, but I see that some people still continue to persist with that. There's great misunderstanding about what's going on in the currency market. There's great misunderstanding about what's going on in the gold market. We see a lot of comments and speculation. It's not even speculation. It's just comments about Turkish central bank gold fluctuations, which have been going up and down really for more than a year. And those comments are almost in a vacuum, completely ignoring the massive economic and financial and political crises that are going on within Turkey, which help you to understand that. And we may try to talk about Turkish central bank gold changes in their reported monetary reserves in a future video. One of the things about Turkey is that it allows its citizens to own gold in bank deposits, and it allows its banks that have gold on an unallocated basis on deposit for clients. It allows its commercial banks to use that gold to meet some of their reserve requirements, their monetary reserve requirements. And as a result, you see gold showing up on the central bank balance sheet that isn't necessarily monetary reserves that have been bought and owned by the central bank, but rather they're gold that's been pledged to the central bank as part of the monetary reserve system that exists within Turkey. And with massive inflationary and economic and currency problems in Turkey, you've seen those the currency market and the monetary reserves fluctuate sharply. Turkey actually banned imports of gold for a while because it was running out of foreign exchange. And then in that situation, the Turkish central bank had to sell some gold in order to supply the domestic market. And the domestic Turkish market is domestic plus in that not only do a lot of Turkish citizens own gold and store wealth in gold, but a lot of other citizens of other countries throughout the Near East, the Middle East, North Africa actually buy gold through Turkey, often storing it there. So Turkey is a regional market that sees a tremendous amount of gold flowing in and out, as well as currencies. And with the Russian invasion of Ukraine and sanctions against Russia, Turkey has become also an important source locale for a lot of Russian and other Commonwealth of Independent State nations in terms of owning currencies there as well as gold. So Turkey is a very complicated subject, and it doesn't really do the gold market or gold investors justice to overly simplify it and ignore all of the massive political, economic, and financial crises going on within Turkey. Anyway, that's probably more than I already wanted to talk about. Just a few charts today. This is U.S. real GDP. I'm sorry about the typo. I'm really bad at these things. They're shades of gray. You can see here that U.S. GDP, we had the big decline during the lockdown. We had the big recovery in 2021. Since that time, we've seen a deceleration of the recovery. We've gone from recovery to expansion. We did have a couple quarters of negative GDP, 0.6%, 1.6% in early 2022. But since that time, we've been bumping along. It's not really high, but it's not really low. It's not black, it's not white, it's shades of gray. Gray with an E if you're in England, gray with an A if you're in the United States. You're going to argue about gray versus gray, but you really ought not to be arguing about the idea that the U.S. economy has actually been in a recession, as some people would say, or as actually facing hyperinflation, as some sane people would say. The reality is that GDP, with the exception of the first half of 2022, has been bumping along pretty much at the same kind of levels that we've seen since 2010, since the Great Recession, since the global financial crisis of 2007 to 2011. So the U.S. economy, it's there. Now, last week when I was talking about the economy, I ran through some numbers to show you pockets of strength. And I made the point that there were pockets of strength and there were pockets of weakness, and one ought to focus on all of it. And I guess because I was dealing with some of the absolute garbage that's talked about in gold and silver markets by promoters about the U.S., being in a massive recession and the government data just lies, I was focusing more on the positive. But in that context, and I said it last week and I've said it for years, we are looking at a recession emerging. Our best estimates are still 2024, 2025. It could occur at any time. Our expectation is that it could be a pretty deep recession for the industrialized countries, not just the United States, but also Western Europe, the UK, and Japan to some extent. You'll see a slowdown. Our expectation is that you would see some slowdown as a result of that in other emerging and developing countries, economies, but that they probably would fare better because they have done some work to insulate themselves from economic weakness in their major exporting countries. They export a tremendous amount of their output to the United States, North America, Europe, Australia. So shades of gray. It's not bad, not good, great. There are a lot of problems that the world economy and the U.S. economy and Europe and the UK and Japan all face, as do China, South Africa, and other countries. And one not ought to be sanguine and expect that everything is going to work out fine. one should be fully cognizant that recessions do happen and that we probably are overdue for one. And there were signs of supply constraints, not supply chain constraints, but supply constraints, and signs of cooling demand for goods and services on the parts of businesses, consumers, and government around the world. And all of those factors could combine with reduced fiscal spending in the United States and other countries to trigger some sort of recession. Our view is that it could be a big one, but the reality is that it could be a shallow one. You see on this chart, the blue line, which are the advanced economies, short shallow recession 1990, 1991, short shallow recession 2000, 2001. It could be something like that, or it could be a much bigger type of situation. Turning to gold, again, it's shades of gray. Gold investment demand remains elevated. We had seen a period of lower demand for gold, 2013, 14, 15, 2018, 2019. In 2020, with the economic lockdown, the global recession, and the pandemic, you saw investors really moving a lot of money into gold, 40 million ounces, and the gold price responded by rising sharply. In 2021, as we came out of the lockdown, people were redeploying assets in other areas. They continued to buy a tremendous amount of gold because of all of those problems that we talk about week in, week out, economic, financial market, and political problems, which have gotten worse in 2021, 2022, 2023. In that environment, investors have been buying 25, 26, 27, 28 million ounces of physical gold a year. That's enough to keep the gold price at record prices in terms of quarterly and annual prices, but it's not enough to drive it sharply higher the way it did in 2020. And that's sort of where we're at right now. If the economic environment gets worse, as we expect at some point over the next say 30 months, then you could see another surge in investment demand for gold. Maybe not the 40 million ounces, but over 30 million ounces. And in that kind of environment, we would expect the gold price to rise sharply. Here you can see three little red dots there. Those are years in which investors as a group are estimated to have been net sellers of gold. 1970, after the public sector gold window was closed for the dollar to be exchanged at $35 an ounce for U.S. Treasury gold. 1971, and then again around 1996. Very small, very rare periods of time where investors are net sellers of gold. Investors, when they're bullish, buy more than 20 million ounces of gold. Investors, when they're bearish, have historically, in the period of free gold prices, bought less than 20 million ounces of gold. Investors, when they're bearish, tend not to sell gold. And so if new investors want to buy gold, or if existing gold investors want to buy more gold, they have to buy it from current supply, mine production, and secondary recovery. Because by and large, on a net basis, investors as a group don't sell. Now, understand that these net figures are the sum of gross purchases and gross sales. And we did talk about it, say, around 2013, 2014, when you had a massive amount of gold bought and sold on gross bases. There's something like, I think you were talking about maybe 80, 85 million ounces of gold being sold by investors as gold went from 1680 to 1580 to 1280 in 2013. Investors were selling. Some of them had bought high. Some of them had said, okay, I bought low, but the price is not coming off. I'm going to sell. But you also had about 10 million ounces of net purchases, which means that if investors were selling 86 million ounces of gold that year, they were buying 96 billion ounces of gold that year. So the net figures are net. They represent the total or the sum of the gold being sold by some investors and the gold being bought by some investors. So to clarify what I was just saying earlier, investors do sell gold individually, but collectively they have tended to be net buyers, because in those situations where investors who own gold are selling it, there are usually more investors wanting to buy more gold in the same year. Why would investors sell gold? Well, in some cases because the price has risen very sharply. In some cases because the price has risen very sharply and now it's falling. In some cases because the price has fallen very sharply. In some cases because the price has been low for a long period of time and people are getting disenchanted. In some other situations, the economic or political environment in their countries have constrained their financial resources on a non-gold basis, and they are deploying some of their gold insurance holdings in order to have money to live or survive or leave the country. So that's the situation with gold and gold investment demand. Again, hot and cold, more warm than cool. It's not 2020, and it's not 2024, 25. It's 2023. Silver's a little bit different because investors, when they don't like silver, they'll sell it. And they sold roughly 2 billion ounces from 1990 to 2005 on a net basis. And it's interesting because if you look at that, you'll see that one of the years of the biggest net disposals of silver by investors was 1997. And those of you who know or have studied or have heard some rumors, many of which are inaccurate, know that in 1997, Berkshire Hathaway bought 129.7 million ounces of silver. And you can look here and you say net disposals from inventories, most of which were held by investors, were on the order of 150, 160 million ounces. So if just Berkshire Hathaway bought 130 million ounces, but net sales were 160, that means that gross sales would have been 290. And of course, it wasn't just Berkshire Hathaway that was a buyer that year. The price was bumping along below $5. Part of the strategy that Berkshire Hathaway had was they wanted to accumulate gold forward purchases below $5. So all of that gold was bought for future forward delivery in 1998 at prices below $5. And other investors were saying, hey, prices below $5, and they've been below $5 for 8 years now. I think it's time that maybe I should start buying some silver. But even as you had this massive rush of silver buying, at least from Berkshire Hathaway, you had other investors continuing to sell because they were disenchanted. Some of them had bought gold at $16 or $35 an ounce in 1980, or $8 an ounce in 1985, or $7 an ounce in 1989, and they were just saying, okay, it's been between $350 and $550 for the last 7 years. I'm out of it. Or my father bought this silver at a high price a decade ago, and he's dead. So as we go through the estate, let's sell the silver. That was back then. 2006 forward, we have seen net investment demand positive for silver. Investors have been buying more silver. And it's interesting because if you look at the demographics of who's buying it, it used to be, like say in 2010, that about 90% of the people who were buying physical silver for investment demand were college educated, upper income, 40 to 65 years old, Interestingly enough, by that point, you had slightly more than half of them being female and slightly less than half of them being male. But college-educated, upper-income, professional people still working, moving some of their assets into silver as a long-term investment. Not because of any conspiracy theories or anything, but because they wanted a diversified portfolio. And 10% of the silver that was being purchased were conspiracy theorists or people who thought that there was a manipulation in the silver market, or people who had listened to these putzes on the YouTube saying, since 1986, so-and-so, this bank or that bank or the next bank after they get out of the business has this massive short position and it's going to blow up in their face and the price of silver is going to $50 or $100 or $750. So buy silver and in 3 years you'll be able to buy a house with 10 ounces of silver. Hate to see that house. But that was 10% of the people who were buying silver back then, or 10% of the silver being bought were those kinds of investors, the conspiracy theorists. And 90% were people who were what we would call rational investors. Fast forward to the last couple of years, and it's shifted, and perhaps 15 or 20% of the silver is now being bought by conspiracy theorists or people who are convinced that the dollar is going to collapse or we're going to have civil unrest, and you're going to need to use silver to buy bread and gasoline and bullets. So you've seen a shift there, and you've seen other investors move away from silver, partly because of distaste for the smudge that is put into the market, and partly because silver really hasn't performed all that well. We still expect it to perform well. We saw a long period of time of weak silver demand. We saw it come back a little bit in 2020, 2021. It fell back in 2022. It appears to be picking up again in 2023, although the rise is somewhat halting. Our expectation is that we'll see further increases in 2024, 2025, if we're right on our expectations that the next 30 months are going to be pretty hostile in terms of the political environment, the economic environment, and financial market stability. In that environment, we would expect silver prices to rise sharply for a couple of years again, as they have 1979, 1980, 2000, really 2006, 2007, into 2011. That's all I have for now. We'll be talking soon, some more. We will be having the CPM Group open forum, challenge your assumptions. It's an open question and answer period. It's June 21st at 11 a.m. Eastern Time. If you are a client of CPM Group, you can plug in, you can ask questions in advance, or you can wait and you can ask the questions during the open forum. It tends to last an hour. Sometimes it goes into 2 hours. We try to not go too long on it because it is the middle of the day for a lot of people in the Western Hemisphere. If you're not a client and you want to plug into that, go to our website, cpmgroup.com, and become a retail investor, buy some of our research, buy some of our consulting, and you'll get an invitation to participate in that. You can go to our website and read about other things too in the meantime. I'll talk to you next week. Have a good weekend. Take care of yourself and those around you, and try to be good to the world, because the world has a lot of people not being good to it, and we need to offset their effects.